Assalamu alaikum. Hello everyone. This is M.Munirah. Today, inshallah, I'm gonna explain to you the remaining of chapter 7, which is note receivable. So, note receivable, it's a promissory note. We are promising that we're gonna be paying in the future some certain amount of money, and because we are paying in the future, there is an interest rate. Sometimes in the note, the interest is bearing, where it's showing and it's stated in the note, and sometimes the interest is not bearing, it's not showing. We call it zero interest bearing. That does not mean that there is no interest rate, but technically it's hidden. So how did we even come up with the note receivable? So we use the note receivable for the customer who wants to expand their payments in the future. So instead of using the account receivable, we're gonna replace it with the note. Or for high risk or new customers, so there is new customers, we don't trust them, so we use the note receivable. Or high risk of a customer, so they may like going to a bankruptcy, or they have a high risk of not paying that amount, so we use the note. Or for loans to employees and subsidiaries, we usually use the note receivable. Sales of property, plant, equipment, usually it's a big payment, so we use the note. Or lending transaction. For example, if there is a bank, they want to lend amount of a cash, they use the note receivable. So all this is how did we even come up with the note receivable? Then we have the recognition of note receivable. So we record the note receivable at its face value if it's for a short time. Usually we ignore the time value of money because the changing is not material, so we don't consider that difference. But if the note is for a long term, we usually consider the time value of money and we're going to record it at a present value. Then we have issuing the note. So let's say, for example, we have notes with 1,000 face value and there is an interest which is annual payment with a 7%. We want to sell that note today. Instead of waiting for years to collect that 1,000, we wanted to sell it today. So we're gonna compare our note with the market. So because there is another market, we have another company, they want to sell their note too. So if there is anyone want to purchase our note, he gonna compare the note that we has and the note in the market. So if the interest rate is the same, so our note, if someone will purchase our note, he's gonna be receiving 7%, which is same as if he's going to be purchasing the note from any other company, he's gonna be receiving 7%. We're gonna issue the note at the face value because the market is same as the stated rates that we has in our note. The other scenarios is that our note has a stated rate less than the market. So let's say, for example, we have a note and our interest rate is less than the one that we have in the market. So if someone wanted to purchase our note, he would probably not accept to receive 5% because in the market, he's gonna be paid for 7%. So no one probably gonna be purchasing our note. So we're gonna discount the face value of the note and we're gonna sell it with only 900, which is the amount we're gonna sell it at a discount. Lastly, we have the stated rate, which is more than the market. So we have a note and the interest is more than the market, which is more efficient. So we're gonna issue the note at a premium because everyone would probably want to purchase our note because we are receiving more than the market. That's why we called it a negotiable instrument, because now the purchaser, he could negotiate and argue based on the market and said, listen, if I'm going to be purchasing your note, I'm gonna receive less than the market, so you have to discount that amount. And by this, we're gonna make that adjustment and we're gonna sell it at a discount. This is why we call this a negotiable instrument. Then we're gonna see how are we going to record the receipt of the notes. So we have 3 scenarios or 3 exercises. We're gonna look at them one by one. So firstly, we have a note issued at a face value. So if the market rate is equal to the stated rate, we're gonna issue the note at a face value. So we had an example here. There is a company, they've lent another company a 10,000 in exchange for a 10,000. 3 years note bearing interest. So in the notes, the interest is bearing, is stated in the notes. So with a 10% annually, which is like payment for annually, and the market rate is 10% too. So the market is equal to the stated rate. We're gonna issue the note at a face value. So we're gonna look at this time line, so we are going to be receiving a 10,000 in the future, right? But how much is that 10,000 is worth today? What's the present value of that 10,000? So first of all, we have an annual payment, which is 10%, the stated rate. We're going to multiply the 10% with the present with the face value, and we're going to be receiving 1,000 annually. This is the first year, second year, the third year, where we're going to be receiving the full amount and the interest. So at the end of the year, we're going to be receiving the 10,000 and the 3,000 too. But how much is it worth today? So we're going to look at the schedule. In the schedule, we're going to take the market rate, and we're going to look at the period, which is the third year, and we're going to take the factor and multiply it with the interest. And this 2,487, this is the present value of the interest revenue. And we're going to do the same thing with the principal. We're going to take the face value, and we're going to look at the market rates. We're going to go to the third year. We're going to take the factor, multiply it with the principal, and then we're going to have the present value of that note. So the 10,000 today is worth 7,513. So if you added the two principal, which is the interest and the principal, if you add them together, the two present value, you're going to be receiving the face value, which is now currently in the market worth $10,000. And we're going to make the journal entries. So the first year, we're going to be lending them our money. So we're going to have a credit cash by 10,000, and we're going to have a note receivable going to be debited by how much? 10,000 too. The second year, we're going to be starting to receive an interest. Right, we're gonna start to receive an interest, so we're gonna have a cash with $1,000, and we're gonna have an interest revenue with 1,000, and we're gonna do the same things for the second 2 years. We're gonna do a cash by 10,000, and we're gonna credit our interest revenue by 1,000 too. Then we have zero interest bearing notes, where technically there is an interest revenue, but it is not stated in the notes. So we have a company. They receive a 3 years at $10,000, zero interest bearing note, and the market rate is 9%. So there is no stated rate. We only have the market rate. So we are not receiving annual payment. So we know that we are going to be receiving a $10,000 in the future, right? But how much is it worth today? Because if we know how much is it going to be worthing today, we are going to be lending them the amount with the present value. So we're going to look at the schedule. We know that the market rate, which is 9%, and we know that the period, which is for 3 years, which is we're going to look at the amount. This is the factor. We're going to multiply it with the face value, which is the principal, and this is how much is it worth today. And this is the amount that we're going to be lending them, because we are going to be receiving in the future the face value, and we are not receiving any annual payments. There is no interest payments, okay? We are not receiving any cash in these 3 years. So we are gonna be discounting our face value with the present value. So we're gonna be lending them 7,721, and we're gonna be receiving the interest revenue and the present value in the future. So technically there is an interest revenue, but we are not receiving that. We are gonna be receiving the interest revenue at the end of the 3 years. But if you look at the T account of the note receivable, we cannot close our T account because the amount is already discounted, okay? So we need to make that adjustment, because if you look at the difference between the face value and the present value, which is the amount of the discount, which is the interest revenue, right? This is how much we are going to be earning. We have to amortize that discount. So we're going to, every single year, we're going to look at the schedule. We're going to every single year take the present value, which is the carrying amount. We're going to multiply it with the market rate. We're going to multiply it with the market rate. And then this is how much we are going to be receiving. This is the interest revenue, right? This is the amount of the interest revenue. And then we're going to deduct it from the cash received, because remember, we are not receiving any cash. And then we're going to deduct the amount. And then this is the amount that we should have amortize. So we will amortize that amount from the note receivable every single year. We're going to take the amount for the discount amortized, we're gonna add it to the note receivable, and we're gonna multiply with the interest rate, or sorry, the market rate, and then we're gonna have the interest revenue. We're gonna deduct it from the cash receivable, and then we're gonna amortize that amount, and then we're gonna add it to the note receivable, and we're gonna do this over and over and over till we close the T account of the note receivable. So now we have to make the journal entries for recording the receipt of the notes. So because we are issuing the note as a discount, so we're gonna have a cash by the present value of the note, and we have a note receivable with the present value of the note too. And at the end of the first year, we're gonna start to record our interest revenue and the amount of the discount amortized, because remember, we are gonna be receiving an interest revenue, no cash. We are not receiving any cash, but we have to record the interest revenue. So if we have any cash, we're gonna debit that cash, but because we are not receiving any cash, we're going to be receiving the full amount in the future. So now we're gonna debit our note receivable, which is the amount that we have to be amortized, the discount amortized, and we're gonna be crediting the interest revenue with the same amount. The last example, which is similar to the zero interest bearing note, where similar idea, the only difference is that we are receiving cash. So we have a stated rate less than the market, so we are receiving an interest annual payment. So what makes it different is that we're gonna be receiving a cash annually. So what are we going to do? We're going to take the face value, we're going to multiply it with the stated rate, and this is the amount that we are going to be receiving annually. And then we're going to take the face value and we're going to go to the same schedule, and for the market rate, we're going to take the period of the 3 years, and we're going to have the factor. We're going to multiply the factor with the face value, and we're going to come up with the present value. And then if you take the present value, multiply it with the market rate, you're going to start to have an interest revenue. And we're going to do this over and over and over, and we're going to deduct the difference between the interest revenue and the cash received, because we wanted to know how much the difference between the face value and the present value. And the difference here, which is the difference amortized, we're gonna amortize it to the note receivable T account. So if you take the interest revenue deducted from the cash received, you're gonna have the amount, and you're gonna amortize that from the note receivable. So we're gonna have the carrying amount, we're gonna multiply it with the market rate, and then we're gonna have the interest revenue, we're gonna deduct it from the cash receivable, and this is the amount that we should have amortized from the note receivable, and we're gonna do the same thing over and over and over. So how are we going to record that? We're gonna start to have an interest revenue we're gonna have a cash received by 10,000, and we're gonna have a note receivable, which is the amount that we should have amortized, and we're gonna have an interest revenue credited by 1,142. So we use the note receivable for property, goods, and services, and the stated rate is considered unfair if in the notes there is no interest stated, or if the stated rate is unreasonable, or if the face amount of the note is materially different from the current cash sales price or from the current market value. All this is gonna consider as unfair interest rates. Here we have an example for note for property, goods, and services. So we have a Oasis Development. They've sold a corner to a Rusty, and they accepted an exchange 5-year notes. So they've made a sale, but they did not receive a cash, so they have a note. Okay, and the maturity is for 35,000. And without stated interest rates, and the originally cost for the land, which is 14,000, and we had a fair market of 20,000, and they used the fair market value of that land. So okay, so we've sold that land, so we're gonna have a note receivable because we are not gonna be receiving in cash. And we use the fair market value, so we're gonna debit our note receivable. And how much is it cost us? Originally for the land, which is 14,000, we're gonna credit that account, and we're gonna see, are we going to have a gain or loss? So this is the amount that we've sold, and this is originally how much is it cost us. If you deduct that amount, you're gonna have a gain on that sale, and you're gonna credit that amount. For the valuation of note receivable, so companies, they record and report short-term note receivable at their cash realizable value, and computation and estimation involved in valuating short-term note receivable and in recording bad debt expense. So we are literally treating note receivable same as account receivable. So if there is some amount we are estimating that it's going to be uncollectible, we should have reduced that amount because we want our note receivable to be at cash realizable value, because we want our note receivable or account receivable to be at faithful representation, and if there is some amount is going to be uncollectible, we should have bad debt that amount. Then we have the day recognition of receivable. So sometimes the company will sell their account receivable because they want to receive cash today rather than waiting for years and collecting that from their customer. So they will write off their account receivable and transferring that account receivable to another parties. So the other parties, he gonna be handling all the risk and the reward for that account receivable. For transferring the account receivable, why do companies sometimes sell their account receivable or transferring the account to another parties? Usually because the company wants like cash today, and they do not want to wait for years, and they have like the need to for that cash, or because sometimes they don't want to waste their time collecting that cash from the customer, wasting the time, and it's costly, so they would rather just selling their account receivable to another parties. And there is two ways to transfer the account receivable. We can just sell that account receivable, or we can secure our account receivable. So let's say, for example, we've taken a loan from a bank. So the bank will secure our account receivable. So whatever we are receiving or collecting cash from our customer, we will be paying that loan to the bank. So we're gonna use our account receivable as a collateral or as a secure. And here we have sales of receivable. This is the basic procedure in factoring. So we have a customer, it could be retailer or house seller. He place an order for a company. So a company could be a manufacturer or distributor. So the company will request a credit review to a factor. A factor, let's say, for example, it's a bank. So the bank will review the credit card for the customer. Let's say that the customer, he's not risky. So he said, okay, now we can approve that customer. He's not risky, so they will approve the credit. The company will ship the goods to the customer, and the factor, which is the bank, will pay for the company, and the factor will collect that cash from the customer. So now technically the customer is not paying directly to the company. There is a factor, middle factor in between. So we called it a factor or a middle factor, where we are not receiving the cash directly from the customer. There is a middle factor in between. For selling the account receivable, we can use two ways. There is sales without guarantee, and there is sale with a guarantee. So selling the account receivable without guarantee, where we cannot guarantee the purchaser for our account receivable that our customer gonna pay you in the future. So the purchaser will handle all the risk. So he might have collect that cash in the future. He might not collect all the amount of the future. So he will handle all the risk and the reward of the account receivable. And because we are selling our account receivable, we're gonna sell it on a loss, because remember, the purchaser, he have to make that earn from that sale. So we're gonna sell our account receivable on loss. And also we're gonna use the seller, use a due from factor receivable account to cover probable sales discount, sales return, and sales allowance. And we're gonna see all these in one example. This is a Chris Textless. They have a factor of 500,000 of account receivable with a commercial factor. So Chris Textless, they will sell their account receivable to a commercial factor without guarantee. Okay, so non-guarantee. And the commercial factor, they will face as a charge of 3% of account receivable, and 5% gonna be on hold just for probable adjustment. So how it's gonna look like? So Chris Textless, they will sell their account receivable to a commercial factor. So now the account receivable is gonna be with whom? With the commercial factor. And from our the Chris Textless perspective, they're gonna have a cash. By how much? not the full amount, because they are facing us a charge. They have to make an earn from that sales. So we're gonna say, okay, 3% from the account receivable, we're gonna multiply together, and then we will deduct that from the account receivable. This is how much we are going to be receiving, and from the commercial factor, they will pay us that amount. So they will credit their cash by the same amount of money, and we have a 5% from account receivable. It's gonna be on hold, just in case, as I said, the customer will ask for a return or allowance. So in the CREST text list, we're gonna record it as due from factor. So in case the customer did not ask for sales or allowance, we will not make any adjustment, okay, because we already debit that amount. In case the customer will ask for return and allowance, we're gonna look, we have to make an adjustment, and we're gonna look at the agreement, and based on the agreement, we're gonna make that adjustment. And from the commercial factor perspective, they're gonna have a due from customer with the same amount. And the 3%, which is the charge from the CREST text list, gonna consider as a loss on sales of receivable. But from the commercial factors, it's gonna be considered as a revenue, because they make a revenue from that charging sales, from that charging finance. Okay, and from the CREST tax list perspective, they will write up their account receivable, because we sell our account receivable to commercial factor, so now we don't have any longer account receivable anymore. And from the commercial factor perspective, they're gonna have the account receivable with a full amount of the account receivable. Then we have sales with guarantee, which is the opposite, where the seller will promise or guarantee the purchaser that I trust my customer and my customer will pay you in the future. So I will not write off my account receivable. Instead, I'm gonna consider as a liability till the customer will pay you in the future. Okay, so there is nothing will be changing much, except we will not write off our account receivable. Instead, we're gonna record it as a liability till the customer will pay to the commercial factor. Then we're gonna write off our account receivable. And here we have an example of secured borrowing. So there's a company, they provide a 700,000 of their account receivable to a bank as a collateral for a 500,000 notes. So they have a note, which is a loan with a 500,000, and they're gonna use they will use their account receivable as a collateral. So till they pay the full amount of the loan, they will use their account receivable as a collateral, okay? And they will face them with a charge of 1%, and because there is monthly payments, it will be always an interest rate. So they will pay a 12% of that note interest rate monthly. Okay, so here we're gonna look at how are we going to be recording that transaction. So this is the perspective of the company, and this is the perspective of the bank. So the company will transfer their account receivable to the bank. So the bank will use this company account receivable as a collateral. So we have to make that transaction, right? And because the company or the bank, they have to make an earn from that sales, which is from that collateral. So they will face us with a charge of 1%. So this is our account receivable. We have a 1% charging fees. So we're gonna multiply that amount, and we're gonna have an interest expense because we are paying our interest. So we're gonna debit that amount, and from the bank perspective, it's gonna consider as an interest revenue, okay? And because they are, lending us their cash, so they will credit their cash, and we're gonna debit our cash by the same amount, okay? How did we come up with this amount, which is the full amount of the notes? If you reduce from it the interest expense, this is how much we are receiving today, okay? And in the future, we are the company or the bank, they're going to be receiving the full amount of that notes and the 7,000, which is considered as an interest revenue. So this is the two perspective from the company and from the bank perspective. Then we have in March a collection of $44,000 of accounts less cash, a discount of $6,000, and we have a receipt of $14,000 sales return. So in March we've have a collection amount of from our customer. We've received some cash, but a part of it was sold at a discount, and we have also a return from that sales, okay? So technically now we are not receiving the full amount. So we're gonna reduce our collection from the sales discount. So this is how much we are receiving, and we're gonna record the sales discount, which is the 6,000. And also we have sales return and allowance, which is contra sales revenue. We're gonna debit that amount. And now we're gonna reduce our account receivable with how much, the amount of the collection and the amount of the sales return and allowance. We're gonna add them all together, and we're gonna reduce our account receivable by this amount. And now, since 1 month have been passed, we have to pay an interest. So we're gonna go to the notes payable. We're gonna multiply it with the amount that we have to be paying for the interest. And because it's been a month been passed, and the payment is for monthly, so we're gonna divide 1 by 12 because this is how much we have in the year. And this amount is gonna be the interest expense. We're gonna debit that amount because we are reducing our expenses. And we're gonna reduce our notes payable with how much we have. So we have only cash with 434,000. We're gonna reduce that too, which is because we are paying our notes payable, so we are reducing our payable too. And this is the cash that we are going to be paying, which is the interest expense and the notes payable. This is how much we are going to be reducing from our cash. And from the bank perspective, they're going to be collecting a cash, which is the amount of the notes receivable and the interest expense. And they're gonna have an earn, which is because the interest is considered as a revenue from them, and they're gonna have a note receivable. They will reduce that amount because they've already received a note payable with that amount. Then in April, we have a part of the account receivable is gonna be uncollectible, so we have to write off that amount. So previously, we've write off a part of the account receivable, and originally our account receivable, which is 700,000, and a part of it was write off. So we have to deduct that amount to know how much is remaining. Okay, so this is how much it's remaining from the account receivable. But now 2,000 from that amount is going to be uncollectible, so we will reduce that amount using allowance for that full account to reduce our account receivable, which is a contra account receivable. And by this, we're going to have our cash at net realizable value. Finally, we have a balance of 66,000. We're going to do the same things because we have to pay the interest for the end of the month. So we will take the 66, multiply it with the percentage of the interest, and then for only 1 month, and we're gonna have interest expense debited because we are reducing our expenses, and we're gonna pay the full amount of the note payable. So we're gonna reduce that amount too because we are paying our payable, so it's our liability is reducing. So we're gonna debit that amount, and we're gonna pay the full amount of cash, which is for the interest and for the notes payable. From the bank perspective, the interest, which is going to consider as a revenue, and the notes payable is going to consider as a note receivable, and they're going to receive the full amount of the cash. And now we have a balance. And here we have another example. It's literally the same as what I explained, but more simple. So if it comes in the exam, it's gonna look like same as here. It's not gonna look like complicated as what I've explained it before. So if it's gonna comes in the exam, expect it to be simple like this. So we have on April, there is a company, they've had a 500,000 of their account receivable. The bank used it as a collateral for a 300,000 loan. So they have a loan, and they are using their account receivable as a collateral. Okay, so and they are facing them a charge with 2%, and they have to pay an interest with a 10%. How are we going to record the transaction? So first of all, we are going to be receiving cash, not the full amount, as we said, because we are facing a charge. Okay, so we're gonna multiply it with the 2%, and then we're gonna deduct it from the note price, and then this is how much cash we are receiving, and this is the finance charge, which is 2% from the note receivable, and we're gonna credit our note payable, which is the full amount of the note payable, because now we are increasing our note payable till we pay the amount of the interest and the payable. We're gonna reduce that account. And then we have a collection of 315,000. So we've collect some amount from our customers. So we're gonna debit our cash, and we're gonna credit our account receivable by the same amount. and then at the end of the year, so we have to pay the full amount of the interest because we didn't pay any interest. So we started from July, June, and April. So the 3 month we didn't pay any interest for. So we're gonna have an interest payable for the 3 month. So we have an interest percentage. We're gonna multiply it with the note amount, and then we're gonna divide the 3 month over the 12 because we only want for 3 months, and then we're gonna have the interest amount. We're gonna reduce that amount because we are paying for our interest expenses, so we will debit that amount, and we're gonna pay the full amount of the note. So yeah, this is the end of the secured borrowing example. And this is the summary of the transferring the account receivable. So you're gonna ask yourself a question: have substantially all risk and rewards have been transferred? So if we sell our account receivable or transfer account receivable, and no, we don't have any risk and reward to that account receivable, we will write off our account receivable. If it's not, we will consider it as a liability. So this is all the summary of transferring the account receivable. Finally, we have general rules in classifying the receivable. All this is just a general rules. What is important is that we have to show our account receivable at net realizable value. We want faithful representation. So if there is any collateral, if there is any risk, if there is anything, it's really important to show. We have to disclose that so we are not misleading our investors, and we want to have just a faithful representation. So if there is any important information, we should have shown that we have to disclose all this information. Lastly, we have analyzing of the receivable. So based on what we are going to be analyzing our account receivable, are we receiving our cash in a good manner? Are we receiving our cash in a bad manner? So we use the formula called account receivable turnover, which is really direct formula. You have the direct information, which is the net sales, and you have a trade receivable for the beginning and the ending balance. You're gonna add them all up, and you're gonna divide them based on the average. You have two accounts, so you're gonna divide them by 2, and you're gonna have the percentage, or sometimes we use the times and sometimes we use the days. If you are using the times, which means we are receiving this account receivable in, so the more we are using this, the more that the times is increasing, the better, and the less days we are using is the better, which means we are receiving our cash in less days, which is, this is all what we want, right? And for the times, which means we are receiving our cash over and over and over, which is a good thing. So if we have a more account receivable turnover, it means we have a liquid account receivable. And based on what we're going to be comparing, based on the company nature of a business. So we cannot just compare two big companies and say, okay, now we have a better account receivable turnover. We have to look at the nature of the business. We have to look at the size of the business, because some businesses, the nature of that business, that they are not collecting their cash in just easily, okay? But that does not mean that their account receivable is not liquid. So we have to compare two companies that they have the same size, they have same nature of a business. So we're gonna have a fair comparing. And this is, I think, the end of the chapter. So if you have any question, just feel free to ask. And thank you for your listening.